So we're live. Very good. So welcome everybody here in this hybrid learning theater at the University of Amsterdam. A very warm welcome to all of you present here. A number of our advanced LLM students in international tax law at the University of Amsterdam, but also a number of valued external guests. And well, today here at the University of Amsterdam, there are two major events, and I want to briefly welcome you to both events. My name is Sjoerd Douma. I'm a professor of international tax law, and well, more importantly, of course, the director of the international tax law program here in Amsterdam. And next to me is Giorgio Beretta, who will say something about the job fair in I think 1.5 minutes, approximately. So two events. The first event is an event organized by the Amsterdam Center for Transfer Pricing and Income Allocation, a webinar on the very important topic of corporate social responsibility and ethics in transfer pricing after BEPS and Pillar 2. Well, I think, Lorraine, all the buzzwords are in there. so that's great. Thank you very much, Lorraine, for coming over all the way from Texas to be here. You will speak together with Hans van Egdom, who is here in his personal capacity and also working at the Dutch Ministry of Finance. The webinar will be moderated by Rutger Hafkenscheid and Rezen Okten, who are both colleagues at the Amsterdam Center for Transfer Pricing and Income Allocation. I think it will be a great webinar, and thanks again, Lorraine, especially for coming over all the way to the Netherlands. After the webinar, we will have organized a job fair in the context of our advanced LLM in international tax law. And for that, I would briefly invite Giorgio Beretta to say a few words about that.
Thank you very much, Professor Douma. Thank you very much, Sjoerd, for introducing the second great event that we have today. Is the International Job Fair that we annually organize for our students at the LLM Advanced Tax LLM program. And it's a great event for students because we have employers coming from the Netherlands, from Europe, but also outside Europe. We have employers also coming from the Middle East for this year. And so I think that is a great event. Actually is the event for students to show their capability, what they have learned during this year, and what perhaps they can still learn today in this morning. So I think that is the last opportunity for, I mean, not the last, but the last before, getting the interview to learn something that could be spent during the interview. So I urge you to, to attend fully and this section. And of course, we will meet later for starting the international job event during the afternoon and the interview. And I wish you all a successful, event, a successful interview, of course.
Thank you very much. Well, that gives us, I think, the opportunity to move on together with us all in this room, but also you, of course, present online. To move on to the webinar of the Amsterdam Center for Transfer Pricing and Income Allocation, may I invite to the stage Lorraine and of course Hans, Rutger and Rezen to join us here on the stage. Thank you very much.
Thank you, Sjoerd, for that great introduction, and welcome everybody. Welcome to our audience online as well. Again, thank you very much, Lorraine, for traveling all the way from Texas to share your knowledge with us today. Today is going to be a bit of a different discussion about taxation. It is almost, I would say, a philosophical discussion with some historical background to it. It's also a discussion that you could have on the dining table with your family and friends if you want to sound smart to them. I think Rutger will tell you a little bit about more technical aspects of that before starting the discussion with our speakers. But before doing that, it is worth to have a brief introduction of ourselves, also for the online audience. And let me start with myself very briefly. My name is Egdom. I've been practicing transfer pricing my entire professional life of 17 years. So I'm a hardcore transfer pricing specialist. I've been at Big Four, I've been in-house, and currently I had a transfer pricing practice at a law firm called Houthoff. It's a large law firm in the Netherlands. And then with that, Rutger.
Yeah, Rutger Afgescheid. I've been in business for, I think, some 30 years. So we're the oldest, the older people in the room here, but not actually not all the time in transfer pricing. I started in transfer pricing, let's say, 15 years ago. But before that, in the Netherlands, transfer pricing was just something that you sort of would negotiate with the Dutch authorities, and that was it. So negotiation skills were more important than knowledge about the OECD transfer pricing guidelines. Having said that, things have changed dramatically over time. And now we even get to the point where not only technical things about transfer pricing are being discussed, but also the ethics of transfer pricing. And I would like to introduce you briefly, just give a little bio, and then maybe you say a few words about yourself if you want to, but let me just first introduce Dr. Lorraine Egdom. She is a Professor Emerita of Management and Research Professor at the Law at the Texas A&M University, and she is well known for brilliantly and eloquently lecturing transfer pricing and international taxation. But even more so, Lorraine always has been a very dedicated supporter of the careers of her students, having placed hundreds of graduate students in transfer pricing and international tax careers. So in that respect, Dr. Egdom is an example for all university professors worldwide. She held various positions at various universities throughout the world, including Harvard University, and she's also a highly respected researcher. Her core research topics are transfer pricing strategies of multinational enterprises and the relations, and that is, I think, is very special, between multinationals and national states. So she certainly doesn't only cover the technical parts of transfer pricing, but also the public. She's dedicated to the public cause, so to say. That is not only to say about in academia, but she's also the devoted delegate of the United Nations Subcommittee of Transfer Pricing, on which we will have a discussion as well. And last but not least, and we're very happy with that, is that Dr. Egdom is a research fellow at the Amsterdam Center for Transfer Pricing and Income Allocation here at the university. So we're very proud to have you here, Lorraine. Then Hans van Egdom. We've known each other also quite for some time, and you've been in business for some time as well. But from the other side, you could say, from the Ministry of Finance in the Netherlands. Hans is responsible, together with his colleagues at the Ministry of Finance, for transfer pricing policy in the Netherlands, and is a delegate and co-chair of Working Party 6 of the OECD on transfer pricing. He is currently involved in the development of Amount B, part of Pillar 1. And Hans has a lot of experience in mutual agreement procedures about transfer pricing. Hans is also a writer. He wrote a Dutch language textbook about transfer pricing, which is, I believe, the standard work for Dutch students. And apart from that, Hans is also a gifted photographer. Although being a government official, Hans will express his personal opinions, which are clearly influenced also by government. If I speak, it is hard for me to speak any differently than just with a certain view from business, and Hans will do so. But nevertheless, he will express his personal opinions. And having heard Hans speak at various occasions, I can assure you that those opinions are highly valuable. we are also excited to have you here. We will have a discussion today in our fireside session, which is, by the way, is the first fireside session that we have ever organized, about corporate social responsibility and ethics in transfer pricing after BEPS and Pillar 2. And when thinking about such a subject, in a way, you would say a discussion about ethics and transfer pricing may sound a little bit odd. If we discuss ethics in taxation, we usually do that in the context of tax planning and tax avoidance. So the question is, so basically ethics poses the question in how much should a taxpayer take into account ethical standards when structuring his or her business. Ethics is more about principles than about rules. Ethics, my mother always used to say, ethics is what you do if people don't look at you, if they don't watch you. So ethicals is not about rules, it's about principles. And interestingly enough, the arm's length, well, transfer pricing is about principles. It's an arm's length principle. So the question may be, yeah, a principle lends itself inherently a little bit less for avoidance, because if you adhere to the principle, then, well, then that includes already ethical standards, you would assume. But history has proven different. Everyone knows the tax avoidance schemes set up by Amazon, Starbucks, Apple, IKEA, and the likes. And all of these avoidance schemes were partly built also on the use of transfer pricing. And the OECD BEPS project was clearly a reaction to it, but again, more rule-based in a way. So the question of ethics and transfer pricing remains an important subject for discussion. And in today's session, we will try to structure that discussion with insights from Lorraine, Egdom, and Hans van Egdom. Lorraine has recently published an article on tax avoidance in which she discusses the subject in the view of the so-called fraud triangle. And that is also one of the first questions I'd like to pose to you. But first, I have a slight other question. You are an extensive publisher, Lorraine. You have published over, I think, 10 books in your whole career, one of which was intriguing to me, The Ethical Professor. So I think the book is mainly about ethical dilemmas for people who are in academia, start their academic career. But it shows that you have a special interest in the subject. So maybe you can a little bit elaborate on where that comes from.
Happy to do that. First of all, let me just say thank you all for coming, and thank you for inviting me to give this first fireside chat at the University of Amsterdam, and for inviting me to be a research fellow at the Center for Transfer Pricing and Income Allocation. I'm delighted to be here and delighted to have this opportunity to have a chance to sit and chat with such distinguished people. Maybe I think a little way to explain my interest in this is I think all of us had a long run interest in ethics to some extent. And for me, the question has been why firms are willing to engage in tax avoidance. And I think it goes back to something much deeper. I'm an economist, maybe that makes sense. It may be helpful for you if I tell you I grew up in a very small town of 3,000 people in Canada on the border with the United States. So I've always characterized myself as a border child. Border children, Canadian dollar one side of the border, American dollar on the other side of the border, the currency moves up and down and prices change a lot. And so what happens is you get interested in where you can buy low and sell high, arbitrage. So what is tax avoidance? Tax avoidance is about taking arbitrage opportunities to reduce your tax or buy something lower. In my hometown, gas prices on the American side of the border were about a third of the prices were on the Canadian side of the border. Why? Because the Canadians had so much taxes on gasoline. You wanted to avoid paying the high tax, you drove across to the American side and filled your car up on the American side. I think we all have various opportunities in our life to engage in these kinds of arbitrage opportunities. We believe them to be ethical for a variety of reasons. So I think my interest in tax avoidance came up from my own arbitrage activities as a child going back and forth across the American border.
And what kind of dilemmas did you occur?
Oh, well, I probably shouldn't tell you some of these, but let me tell you just one. On the Canadian side, the Canadian government had a regulation that said it was to subsidize the butter industry. So margarine was white. And so it looked like shortening. On the American side, there was no such regulation. And so you could buy yellow margarine. My mother liked yellow margarine. So she would send us across, walk across the American border, buy American margarine and smuggle it back over. So as a child,
Oh,
I
wow.
smuggled. My father smoked cigarettes. Cigarettes were half the price.
Is that the term of that is?
Statutory, I'm very young. Anyway, what I'm saying is, I think we've all, to the extent any of you have traveled, I'm sure you've had the same sort of thing where you've looked at a price on one side and a price on the other, and you've bought low. And,
So pricing ethicals have been, well,
well,
subjects that have intrigued
arbitrage
you.
activities have
Yeah.
interested me for a long time. Why they arise, how people take advantage of them, and whether doing so is either legal or illegal or ethical or unethical, as simple
There is
as it.
apparently also a point at which you believe it remains ethical to arbitrage, and there is a point at which it is no longer.
It's a fuzzy line and different from one individual to another. And I think that was one of the things that motivated the article that Murphy Smith and I wrote, was what I see as ethical, you may see as unethical. What I see as legal, you may see as illegal. And we need to try to come to a better understanding of where the lines are between legality and ethics, what the overlaps are.
And in that article, you introduced the concept of what the fraud triangle,
Mhm.
which I think to be a concept is lent from the audit practice, isn't it?
Came out originally from accounting and audits,
Yeah.
yes.
Yeah.
Mhm.
Can you explain the audience a little bit what the fraud triangle includes and why you thought it was interesting to introduce it also into the world of tax avoidance and how it can help us?
I think happy to do that. I realized in sort of prepping a little bit for this talk, the original fraud triangle paper was written in 1953. It's 70 years old this year. It's an anniversary. We should be celebrating the fraud triangle. We can call this a 70th anniversary celebration. Donald Cressy wrote that article in an accounting journal, and he wrote it basically to explain why individuals engage in fraud. In other words, it's about the antecedents of fraud, what causes people to engage in it. And it's a triangle, so it has three things, three corners. One of them is you have the opportunity. The opportunity presents itself like an arbitrage opportunity going across the border. The second thing is there's a motivation, there's a reason, there's an incentive for you to do this, or there's a pressure for you to do this. You know, I think of those as the carrots and sticks. You know, something pushes you or something pulls you to engage in this fraud. And then lastly, you rationalize it. You rationalize it by saying everybody else is doing it, you know, or, you know, that's the littering. More people litter because they see people littering. I don't believe anybody's getting harmed. I believe in the Milton Friedman's view on shareholders. And I'm supposed to be maximizing shareholder wealth, then I maximize shareholder wealth by engaging in tax avoidance behavior. So I think it's an interesting perspective to say that if you look where there are opportunities, and there for some reason are lots of opportunities to engage in fraud or tax avoidance or transfer price manipulation, and you have reasons to do it, carrots and sticks to do it, you assess the benefits and the cost, you're a rational actor, assess the benefits and the costs and the risks, make a decision that the net benefits are positive. And then you say, well, it's for the good of the firm, right? Nobody's being harmed, so why shouldn't I? And people engage in that. I should just add one point, Rutger. There have been a lot of variations on Cressy's original article, and it's really interesting to read that literature and see how it changed over time. But one of the things that struck me is that, and some people have argued there's a fourth component, so it really isn't a triangle, and that's capability. You can have the motivation, you can have the opportunity, you can have rationalize it, but maybe you don't have the capability. And I think of capability in the sense of entrepreneurship, your scanning ability. You see the opportunities better, you know how to take advantage of those. And so I think
You have a better
capability.
position in a way.
Yes, in the management literature, in the strategic management literature, there's a lot of research now on the resource-based view and the importance of capability. And so and I think this is a way actually to tie some of the behaviors of big four firms to this literature, because certain types of organizations may specialize in developing a deep knowledge that then enables them better to take advantage of these opportunities. So there's an interesting overlap with the entrepreneurship literature here on why some people become entrepreneurs. They scan better, they have the capability better, they know how to exploit those opportunities. So it's two literatures that have some links.
It's interesting, since I've yet read your article, and it's not the first time you talk about the triangle. I think you have a presentation in 2010 already.
Yes.
Talking about this topic right after the financial crisis.
Right.
The dangerous thing is, once you read about the fraud triangle, you start looking at almost everything through the lenses of the fraud
That's
triangle.
right.
There's a case going on. I don't know if you're into football and models, but a football player recently got into a divorce procedure, and his wife took him to the court to basically, he's a very famous football player for playing for Paris football team, a lot of money. So he took his wife went to the court claiming half of the wealth or whatever that is, and it turns out that he put almost all of his wealth in his mother's name. The first reaction is not at arm's length. Secondly, fraud triangle. But the judge basically so far thought it was okay to do so. And this brings me to, how does the fraud triangle basically, how can we use fraud triangles for transfer pricing purposes, for tax purposes, and but the motivation, opportunity, rationalizations? How do we identify these cornerstones and use that in practice?
Okay. And the way I think about it, and sort of way we explain it in the article, is, first of all, transfer pricing is the setting of prices for related party transactions, right? The organizations are commonly controlled, and so there's the opportunity to engage in this behavior. The way I think about the setting of transfer pricing is through things that you would have learned here in class on the arm's length principle, that governments require firms to set prices as unrelated parties would have done under the same set of facts and circumstances, if we could make that determination. So the question then becomes, why do firms manipulate transfer prices so that they don't comply with the arm's length principle? In other words, why do they engage in mispricing? Or I think of it as aggressive transfer pricing or abusive transfer pricing, if we can figure out where that is, but that's the idea behind here. And the fraud triangle helps, I think, because it talks about the antecedents. What are the causes of it? Well, the causes of this are the opportunities for it, the motivations, and the rationalization. So let's start with the opportunities for transfer pricing. Arbitrage. I'll come back to me growing up on the border, looking at price differences across the border. In the international tax system, there are all kinds of holes and opportunities and gaps that firms can profit from arbitrage, right? Just simple differences in corporate income tax rates. Most countries have a territorial tax system, so they no longer tax foreign source income, right? So foreign source income is taxed more typically at a lower rate than the rate is at home. There's an arbitrage opportunity. The rise of tax havens and special purpose vehicles provides an arbitrage opportunity where you can take advantage of locational preferences. I think there are multiple opportunities in the system. I'm an American citizen now, and I live in the United States. And I say one of the biggest holes in the system is the check the box regulations that the US government has had in place since the late 80s. I mean, it's a major hole in the international tax system. It allows a firm in the United States to have an offshore entity, and it's treated as active business income in one direction and passive income in the other, and gets away with no tax in either. So the US regulations encourage those holes too. It's not
We
not
touch
just
upon
havens.
that, I think, that subject later, also with Hans, because I think what you do is you put a perspective on on tax avoidance and the abuse of transfer pricing from two sides. One is, the business who has the opportunity
Yes.
to do so, and apparently also the incentive, and is capable of has the capabilities, and we'll dig into that later. But also is able to rationalize. That's the one side of the ethical question. Another side is also, you mentioned already, the United States using their check the box regulations to create holes in the system in a way that is something that states do.
Yes.
So we'll dig into that later. I have one question that intrigues me. Talking about, you were saying, for example, the capabilities, and you there briefly mentioned the role of the Big Four. Can you explain that a little bit, what you mean with that?
I think it's less visible now for this generation than it was for me 20 years ago. But basically, starting in the late 1990s, the Big Four firms started growing their transfer pricing departments very, very rapidly. The numbers went up. And they started building a capability in transfer pricing. Remember, the Big Four firms both have a responsibility for audit, but they also have a responsibility for consulting. And there's supposed to be a Chinese wall between the two. I had transfer pricing students taking auditing jobs. I had transfer pricing students going into consulting work. This was at the beginning of the time when firms realized that the intangibles, they could put the ownership of the intangible asset in one location and then actually have it used in another location. So in effect, separate economic allegiance from legal title, and then shift the profits where the legal title was, not where the economic ownership took place. And I think the Big Four started selling tax planning. They're very much engaged in selling different kinds of tax planning.
Using
and
actually that opportunity.
And because they understood the holes in the legal system better than others, and therefore could come up with different frameworks. And I will name one, Dutch sandwich, right, in this room. I will. And so these proposals for various ways to avoid withholding taxes, to take advantages of difference in rates, take advantage of territorial tax systems, so offshore income wasn't taxed. Problems with controlled foreign corporation, the CFC rules, the check the box opportunities. You had firms that specialize in figuring out how to use these so as to create opportunities to reduce tax. And if you go back and use the time clock on the internet and go back to look at the firms, the advertisements that the Big Four firms were doing, say in the around 2000. It's very clear that they were very actively engaged in tax planning operations and thought this was very profitable. And I think, I will say, I will put myself in the same category in this sense. I wrote my dissertation on transfer pricing. I published a lot on transfer pricing. And in the very first book I did in transfer pricing with Alan Rugman in 1985, we talked about non-market imperfections. Tax differentials were non-market imperfections, and an efficient multinational took advantage of these non-market imperfections, right?
Which
to
is basically
arbitrage
some
the
sort of a rationalization.
Yes.
Using
and what
euphemisms.
was Milton Friedman. It's because Milton Friedman, the goal of the corporation was to grow shareholder wealth, right? Not stakeholder, but shareholder wealth. And it was efficient. And so you should be arbitraging the taxes. And there was, I think, very much a rationalization that this was efficient and it grew the economy faster and created more, grew the pie, grew economic growth faster.
So it was
I think-
even some sort of capitalistic
Yes, very much so.
demand that you had to do that. Sort
I
of.
think so. I think that we live in a different world today. But the world of 2000, the world up until everything kind of crashed in 2008, 2009, was a world where we saw the role of the corporation was to maximize the profits of the shareholder. Judge Learned Hand, and so on. I don't know, Hans, do you think the same? I think the view was very different in that time period.
I was working, I worked for a couple of big four, so you're not gonna guess which one, but I guess that's not maybe too common to one of them. I remember there were awards being given to the most creative tax planning structure every
Yes.
year. So, it cannot get better
Did
than
you
that.
win?
I was not that good. So
He already was very ethical at it.
Okay. I'm by background an economist, so I look at principles more than rules, so to say. But let's turn to the role of the government at this stage, maybe just to kind of balance that a bit to see how governments looked at that. Hans, one of my first encounters with Dutch tax authorities was back in 2009 when I was taken to a meeting by some tax advisors, a bunch of tax advisors. I was a transfer pricing economist, basically working on the numbers. We were in this meeting, I think it was a head office, PE relation, head office in the Netherlands, PE somewhere else, maculadura regime. And then it was pretty much a negotiation. There was transfer pricing study, but can we get a little bit more for giving you certainty? And then fast forward a few weeks ago, I was sitting with the same tax authority, different people though, and I was trying to convince them that they should get more on the case that I was doing. And they would say, no, we cannot defend this. This is too much for the role of the Dutch company. A lot has changed. You have been working at the Dutch tax authorities for many years. So was ethical aspects ever a concern in this, let's say, change? Was it taken into account in the decision-making process? Can you tell us a little bit about how the change has happened over time?
Yeah, I think you have to go a step back because it's a question what is good or bad in the end. And if I ask what is good or bad in transfer pricing, and I ask all the people here in the room, I will receive a different answer. So it depends on what do you want? What is your ideal world where you want to live in? And is it good for the Netherlands, or is it good for Europe, or is it good for the world? And I think you saw a change also. It's also the political change, how to approach transfer pricing during those years. But the problem is still that in the past you also had the advanced pricing agreements where it was possible to have tax certainty upfront. And I think that's a good thing. And it was also one of the reasons that companies say, now it's good to have a discussion with the tax inspector because they are very transparent and they do a good thing for me. And I do not think that is bad, but there was also another side of the coin that people thought, no, they make deals with companies which are good for them. There's no need to pay a lot of tax. So that makes it a little bit problematic because I think the arm's length principle, now Rutger said it's a principle, so there's a strong relation with ethical behavior. I think the problem with the arm's length principle that there is a range of possibilities and outcomes for the same transaction. If you look to and especially what I see from benchmark studies, also the Big Four, then you have a range of remuneration, which is from 3 to 8%. So it should somewhere in the middle or a lower point in the range or higher point in the range. And that gives the possibility to say now, taking into account the tax rate of that country, I want to be in that part of the range so that it's cheaper. And as tax authorities, and I have been in the position, when I look to the guidelines, it should be a point in the range. And if you do not exactly know what it should be, what should you say if the company comes to you and say, I want to have the lowest point or the highest point, dependent on what is the advantage in the transfer mispricing, if it's transfer mispricing. So there are a lot of possibilities in the arm's length principle because it is a principle, but it's not completely clear what the outcome should be. And there are also different interpretation of the arm's length principle by different countries. And in the past, I saw, especially between maybe between the US, where they have more a legal approach, what's in the contract that should be priced, and the Dutch approach, where they say, now we have to look more to the substance, more an economic approach. And that's also, had the effect that in different countries, you have a different outcome, and gave the possibility to do on, now in the end, part of the profit was not taxed at all. Was that not ethical from the position of the tax authorities? I really do not know. We did what was in our law, but we had a principle which gave a lot of possibilities to do on tax planning. So maybe part of the problem is also the arm's length principle as a principle, which is a very difficult principle, especially because we compare related companies with unrelated companies. And my position is that's impossible because the companies who are related have chosen in the past to be related because there is an advantage, synergies or whatever. And if you only compare them with unrelated companies, now there's no synergy because they didn't do that together. So that's also a problem that in the end I saw a lot of BEPS problems because the advantage of the synergy was taxed in a tax haven, because all the normal tax authorities say, no, I want to have a piece of the cake, which I compare to what unrelated parties are doing, but the advantage of synergy, nobody taxed that part, and it was shifted to tax haven. So that's the arm's length principle gave and still give, I think, the possibility to do on transfer mispricing or abuse or whatever, and that's still in the system.
Well, not without any connotation, just arbitrage. Huh?
Yes, it gave the possibility to do that, and that's still happening. And as a delegate in the OECD and Working Party 6, we had a discussion a few years ago about profit attribution to a permanent establishment, and we had one case. It was the same facts and circumstances, and we asked all the delegates of all the countries to give the answer what would be the profit allocation to the PE in such a situation. The ranges of answers were enormous. Some say all the system profits should go to the permanent establishment, and others say I want to only allocate a routine remuneration. And they had very good arguments. But it was not clear how to use the principle for a specific facts and circumstances of a very simple case. So if that's the case, and it happens still, I see it still happening, that countries have a different interpretation. What is arm's length? You will have that problem continue also after BEPS. So I think we have to think, if we want to have a better world in the end, if the arm's length principle is the, I think at this moment it is the best we have because there's not an alternative, but it still gives possibilities to have a profit allocation, which is not what most of the people in the Netherlands, I think, thinks is an ideal situation. So that's also a problem from a government perspective, because I can imagine that firms likes to pay as not a lot of tax, just like we also go to Germany when the fuel is cheaper there. So everybody does that. So you do not like tax avoidance only when you do it by yourself, is my idea. So I think for government, it's the goal to have a very clear understanding what they want and what they want, not only for their own country, but for the whole world. And then it's also important to think about, what is my ideal world and what is an ideal way of splitting the pie of taxable income over the world? Do we do that based on what the OECD said 8 years ago, based on value creation, or should we do it based on where the consumer lives? And will that lead to an outcome which is in the end ethical or whatever? So the first thing is, what do we want? What do we think is fair? And based on that, I think governments have the responsibility to think, how should I do that with my tax system? And especially on, you can think about check the box rules or deductions rule of interest. But for transfer pricing, we still have the arm's length principle, which is an arm's length principle, only 100 words in our tax law. It's not more. So we give everybody the opportunity to make their own interpretation how it should work. And that's a question if that will work in the end.
Just maybe that point, if you're a tax advisor in the Netherlands, and I think in some other countries, you're part of professional organization like Dutch Association of Tax Advisors, one of the first trainings you do is Code of Conduct and Ethics. How do you take that into account in your tax advice? Whether that works or not is another question. But if I look at the tax authorities, I don't think, as tax inspectors part of NOB, Dutch Association of Tax Advisors, do you have similar trainings as to, what defines the boundaries of ethical behavior?
No, we do not have. So it's an interesting question. Should we do that? I think that's a difficult question for us because we have our law, and we should do and look to companies if they do it as it is in our law. We had a discussion in the past that we also in what we call the horizontal monitoring and have discussions with companies about their tax returns. If you also should have the discussion about if their tax payable tax is a fair share. And in that discussion, we had internally a debate about what is a fair share, but that's strongly related to the question about ethical behavior. And there were two different groups also within the tax authorities. Some like to have such a discussion also with companies, what is a fair share, or when a specific structure was avoidance or not, and it should, if you still could be within the in the program of horizontal monitoring, if you had certain structures which were within the law but were maybe not ethical or what were avoidance. But that's very difficult for us to have such a discussion. So other parts of tax authorities say, now when something is within the law, I should agree with it, and or we should change the law because we are a government official and we are dependent on what our parliament is saying what we should do. And if it's a gray area, then we can can do our work within that gray area. And only when the parliament say that should be different, then they should give the rules how to do that. So we had that discussions, but we didn't have a lot of seminars or training or whatever, but a lot of internal discussions how to do that.
Maybe a question also for you, Lorraine, because you took the perspective on the subject from both business side as well as state side. And we already discussed, for example, the American policy of accepting holes or even creating holes in the system, so as to abuse or use, if you may say so, transfer pricing partly also as a means of tax avoidance. How did you, or would you advise states to in their discussion about ethics, corporate social responsibility, but more on ethics when using the policies in terms of transfer pricing? Because what we hear from Hans is there is a wide variety of how states look or governments look at the allocation of income, which is quite logical. It's also an economic and therefore a political issue. But if you were to advise a state, like for example, Hans, the government, the Dutch government, on what should they do? What processes should they have, or what would you advise them to do to include ethics in transfer pricing policies?
Oh, that's a $64,000 question. To say maybe 64 million these days, given depreciation in currencies. Let me have a go at this record. I think that government tax authorities, and I've worked primarily, I guess, with Revenue Canada. Started training Revenue Canada in the early 1990s. And some with the U.S. tax authority here. But I think the key thing is governments need to set up a tax system, recognizing that people voluntarily pay tax and firms voluntarily pay tax. And you want to encourage that voluntary payment. In many developing countries, that's part of the major problem, is that individuals don't, really, there's a big underground economy and there's very little tax revenue generated. So you want to encourage the voluntary payment of tax. How do you do it? You make the rules easy to follow, right? You make them very clear. You make them fair, or the sense that individuals feel everyone is contributing their fair share. And you do punish egregious behavior, because that also has an impact. You have reputation issues. I also think that part of the real problem is not so much any individual government doing it. It's the problem of competition across governments. I mean, think about it. The basis for the system that we have today here is 100 years old now. And it really is. In 1923, 4 lawyers published the original, for the League of Nations, the original proposal setting up the rules and principles for the international tax system. And Josiah Stamp and Siegelman, and I forget the names of the other lawyers. I'm sure some of you remember that was 100 years ago this year. It was. And they based it on a very clear concept called economic allegiance. That basically you should, where there was an economic allegiance type, would then determine where that income should be allocated. And we got residence and source principles. We got things like, let's talk about the water's edge, and then whether the residence or the source country came first. And then we gave tax credits. We made room for the other country. We had, I thought, if you go back and read that literature, I don't know, as law students, whether you go back and study some of the history of international tax law, the economists and lawyers that did that work in the 20s, really quite amazing writing, I think, and very clear-headed. They understood the problems that it was going to create. They understood tax competition could lead to a race to the bottom. They understood that the system was going to be volunteer, and you needed to encourage firms and individuals to pay their taxes voluntarily. And what they realized is that countries have a sovereignty. National sovereignty is very important to a government. A government wants to be able to pick its own tax rates and set its own taxes. Some will rely more heavily on VAT. Some will rely more heavily on income tax. The United States is the only major economy in the world that doesn't have a VAT now, right? So the differences in tax policies are a national issue, national sovereignty, and facts and circumstances differ. Taxes that you can raise in Botswana are going to be very different than taxes in the Netherlands, because the facts and circumstances are different across countries. And the size of the underground economy is going to be very different. So I think what's happened is, if we just each sit in our own country box and we say, let's figure out the tax system that's best for the United States, or best for the Netherlands, or best for Canada, or best for, some other country. What that does is it ignores the spillovers and externalities across countries, and it has a tendency to create tax competition to attract foreign direct investment. Every country wants jobs and employment and good jobs, high, up the value chain jobs, right? And to do that, you need to attract in those kinds of businesses, and taxes have been a major attraction to bring in foreign direct investment. So there's a tension against wanting to have tax revenue and wanting to have jobs. And I can tell you where the Canadian government came down. The Canadian government, for all the history that I was in Canada, came down on the job side, not on the tax revenue side in terms of multinational enterprises. And I think that's always going to be an issue. That's why I think cooperation is so important. And the OECD really was at the forefront of this. The setting up of the double tax treaty system, the bilateral tax treaties, which was done through the OECD, the model convention, the OECD model convention, these were encouraging cooperation across states. Now, I will sit here as a representative of the US subcommittee on transfer pricing and say, if you're in a developing country, you look at that system and say that system was set up to benefit capital exporting countries. OECD countries are primarily capital exporters. It's to benefit capital exporters. And the purpose of those double tax treaties was what? To avoid double taxation, not to avoid under taxation, to avoid double taxation, right? And then the worry was, let's get rid of withholding taxes. Source countries use withholding taxes. We want to get rid of the withholding taxes. And again, I think all of this started to change as I watched through my career, this whole focus on the economics and seeing, as long as you abided by the rules, you used the rules, but you were within the rules. What was legal was ethical. That started to collapse with the digitalization of the economy, the growth in intangible assets, the mobility of intangible assets, the ability to put legal ownership there, and economic allegiance there, right? And then I think, I was looking at my notes on this. In the year 2000, the World Group of Churches published its first report on saying transfer pricing was unethical. And I remember seeing that report in 2000 thinking, I can't believe this. Why is transfer pricing unethical to me? But it's about that around the millennium, this switches. And the focus on that the OECD had been so on capital exporting, on the creation of jobs, encouragement of foreign direct investment, and avoidance of double tax starts to shift as firms start, I think, moving from using the rules to abusing the rules. And that's the part, and I agree with Hans. The arm's length principle is, how shall I say it? It's malleable. Maybe malleable is a good word for it. In the sense that you and I can talk about what we think it is, but there is always going to be an arm's length range. And if you're inside the arm's length range, either up one end or the other, you're still inside, right? But then again, I come back to the broad triangle. There were opportunities, there was motivation, there was rationalization, and it moved from using the rules to abusing the rules. And then you get the world churches, and then you start getting the financial and I'm looking, Richard Murphy started the group. But you start getting NGOs, non-governmental organizations saying transfer pricing is abusive, transfer pricing is unethical. And I wrote an article basically saying, don't shoot the messenger. I don't think transfer pricing is the problem. The problem was the shift to territorial tax systems, tax competition focused on creating of jobs, locational tournaments designed to attract inward foreign direct investment, and then the growing capability in figuring out how to take advantage of all those existing loopholes. For me, BEPS 1 was really a move in the right direction. It was a correction back. That BEPS 1 was an attempt to try to get rid of some of those holes. It brought in information exchange, country by country reporting, sharing of information between governments, more cooperation, government to government.
But on the arm's length principle, was that?
Well, I think the move to value creation, action items 8 to 10, I'm for that. So in other words, I think action items 8 to 10 are consistent with the arm's length principle. And I see the arm's length principle maybe as a thought experiment. What would we do had we not been related? How would we have? And so for me, I agree with you that synergies are an issue. And this is why I've done some work with Yves Hervé and others on Shapley value. I think Shapley value is a way to actually handle the issue of synergies. And maybe I'll shift conversation. Go ahead.
We'll talk about the future of transfer pricing in a second a bit in terms of where it could go, also in terms of the arm's length principle, how it could function better. We have some questions coming in as well. And by the way, from the audience, we can also take questions.
Can you read that?
I
don't even try.
No.
That's why I have this one with me, so I think there's an interesting question which ties in nicely with the discussion we had so far. And it's from a gentleman called Jack Fernandez. Since the discussion has focused on tax avoidance rather than evasion, I think, it is not only about tax avoidance, it's tax planning, avoidance, evasion, all the way to fraud. But let's, take that as this. Do the panel see any differences between issues in TP, tax, versus other areas where businesses could seek to reduce their expenses, maximize their profits? And he gives some examples like, labor, minimum versus living wages, safety or product quality standards, emissions. I think he refers to the environmental issues and so on, which is kind of putting a lot of pressure on companies to comply with the standards. Is so far also mostly not legally driven, but more principle driven, I would say. Maybe we're going towards legality, but how do you see that comparison? Can you share any views on that? Whether, it is different than other areas in businesses, taxation versus other areas?
Maybe it's good to give an example. We had a degree on transfer pricing where it has been stated in the past.
We is in the Netherlands. Right?
We in the Netherlands, sorry, yeah. The Dutch government, where we say, transfer pricing, the tax inspector should be reluctant to give a penalty in transfer pricing cases because the ranges are so wide, so we can make adjustment, but it's not it will not very happen that we also give a penalty because it's maybe tax evasion and not only tax avoidance. But you see also here a shift in transfer pricing arm's length principle, that we have now a few cases and they are public because they were in court, and just because of the penalty there was some publicity about it, where also in transfer pricing cases we had some penalties. So I think in the past, in the transfer pricing world, the idea was, a lot is possible, so you can make adjustment, but now it's always within what's possible. So it's flexible from that perspective. And now you see a change that for those structures where maybe 20 years ago, the big four say, hey, come to us, we have a good idea, that you see governance now more also are more aggressive against these kinds of things, and also willing to go to court for it. Because in the past, and I think Rutgers said it, you go to the tax inspector and you negotiate it, and in the end something in the middle. But there you see a change, and that's strongly related, I think, with the public discussion about ethical behavior. That in the Netherlands, the Dutch tax authorities say now that's not the way we do it anymore. When it's clear that it's completely wrong, it's not alone avoided within the rules, but everybody who sees such a structure would say that's nonsense. Unrelated parties would never do that. Then also, there's a risk of a penalty. So there's also a huge downside risk for companies to do that. And we are happy also that it has been in the newspaper. So I think the debate also between advisors and companies, there are some borders where I should be within. So I think that's a change. But compared to the past, we didn't have such, we never go to court, or nearly never went to court. And nowadays there's a change.
And that's, I guess, specific to maybe Dutch tax authorities. In other countries, I guess, it could be a different approach. For instance, India is a good example. That court is a very, very common route. Do you see any differences in that approach, Lorraine?
Well, my sort of view on here is there are enormous overlaps. I've spent most of my life studying what I think of as multinational state relations, political economy issues. And so whether I'm looking at transfer pricing, or I'm looking at corruption, or I'm looking at corporate social responsibility, or I'm looking at gender equality, I think you can grow, or economic development, I think you can go across these and you could say, let's talk about the antecedents, the causes, and then let's talk about the consequences and the policies that are put in place and what the policies are. And I think there are lots of overlaps and ways to think about this. Maybe one thing to say is in some of the work I've been doing, I use a concept that's a political science concept from international relations theory called international regimes literature, which argues that regimes exist in different areas. They're cooperations among nation states in areas that are difficult areas. And I've argued there's an international tax regime and a transfer pricing regime, but there's an international environmental regime too, right? There's a regime in debt, there's a regime in finance. And if you're a regime scholar, the latest work that's been being done in this area these days is on complex regimes. Complex regimes are overlaps among these. So if you're interested in corporate social responsibility or the sustainable development goals, for example, let me give you a very simple example. My work on gender equality. A lot of the literature that UN Women have done on this argues that gender equality is fundamental across the board to all the SDGs. It's in many ways the most fundamental of the SDGs. You move more in gender equality, you get a lot of movement on many of the other SDGs. But people tend to study the SDGs in silos in one or the other. And I think that's been very true in the tax realm. People who are tax experts study tax, they don't necessarily study, for example, trade or finance or fraud, so much so that they don't see the overlaps here. One of the interesting things I think is to try and link the corporate social responsibility literature with the tax literature. And you get there through ethics, I think. The idea that firms are social organization structures, and they, as members of society, have rights and responsibilities, one of which should be to their stakeholders, not just their shareholders, but to their stakeholders. That literature is an attempt to situate the multinational enterprise and tax in the context of corporate social responsibility. And if you go that way, then you can then link to the SDGs. Because basically you can say, if you want to get movement in the Sustainable Development Goals, you need to get it through one way, important way to get it, particularly for economic development in developing countries, is through tax. If you look at the economics of the international taxation, one of the single major gains a developing country can get in terms of economic development is the ability to tax foreign source income of foreign multinationals in these developing countries, right? It's very difficult to do that under the prior system. And I think part of the reason for this idea that we should be thinking about tax and the payment of tax and fair tax as part of the responsibility that not just individuals, but that corporations have as members of society. And actually, I think that view resonates better in Europe than it does in the United States. It does. The more focus on corporatism in the US and on stakeholders as compared to, in the US is much more, I think, a stronger focus on shareholder capitalism, whereas here it's more a focus on stakeholder capitalism. So I think the CSR, corporate social responsibility literature can link to tax and should be linked to tax.
I think that sounds like music to the ear, especially talking about sustainable development goals of UN. How do you see that coming into practice, apart from, benefiting from literature and bringing that together? Of course, that's the work of, students, researchers, and hopefully that will evolve. But is there any work being done to let's say, create some consistency along the lines of the sustainable development goals, including taxation?
I think there is one group at the OECD that is focused specifically on the volunteer payment of tax. I'm blocking on. It was created about 2 years ago. Hans, maybe you remember.
I don't know if it's.
I know Jeffrey Owens is doing some work that is linking trade with tax with sustainability. I would like to see more in this area because I think it's a natural link between the SDGs and a focus on economic development is tax. And I think fixing some of the loopholes in the system, continuation of the BEP1 initiative, for example, and then we can talk about the BEPS2 initiatives separately. I think fixing some of the loopholes and changing the tone at the top such that executives of multinationals don't just think their purpose in life is to maximize the shareholder wealth, that they are socially responsible organizations. Maybe I'll just say the CEO of Unilever for a long time was Paul Polman. Paul Polman, you will know, Kofi Annan brought on to at the beginning of the Sustainable Development Goals. Paul Polman started a company called Imagine that is focused very much on corporate social responsibility. I am Dean of the Fellows of my professional association, the Academy of International Business. We are giving the Executive of the Year this year to Paul Polman. So I think it's the 7th of July, I'll be on the stage in Warsaw with Paul Polman giving him the award. And we're giving it to him because both in his role as former CEO of Unilever and in the work that he has done since then on the Sustainable Development Goals, he exemplifies what we hope we can help to create in terms of new CEOs and a new role for multinationals in the 21st century that is, focused on payment of fair tax.
Interesting. Yeah. How, to which extent, I heard you say already a couple of times that we as tax lawyers might have a little bit of a too technical view, or we're educated a little bit too technical and are not being educated in a broader sense. How would you, if you had advice on that, what type of things would you include in the curriculum of, and we're here at the University of Amsterdam, so we might need some pre-advice here. But I'm interested in the subject. I already support for a long time that we should include a course on tax on history, basically tax history, because very little people know about where things came from and thus have a difficulty. So that might be one idea, but maybe you have some more ideas.
Well, let me say, I'm not trained in the law. I've worked with lawyers on and off most of my life. I do consulting and transfer pricing controversy and have been an expert witness a couple of times. So I've had a lot of working with them, and I am pleased to have a non-salaried position with the law school at Texas A&M. It's just, I've really very much enjoyed. Having said that, when I was running the transfer pricing Aggies program at Texas A&M, I used to say transfer pricing is like an elephant, in the sense that, you know, you could, the people who focus on the trunk thinks it looks like a trunk, someone who looks at the ear, someone else who looks at the tail. And the best way to study an elephant is to have multiple experts in the room with all different backgrounds. And I said, I want you to go take a course in strategic management. You need at least one course in international business so you can understand how firms think and what they're trying to do in international business strategy. You need a course in economics. You need to understand about arbitrage and how arbitrage works and what you can do and do this. And of course, in political science, I found regime theory very helpful for thinking about how international law has led to the system that we have. It's a frame. I think what happens if you go from discipline to discipline, you get different frameworks and you realize that they help you think about the world more generally. Maybe it's just because I started teaching a career in economics. I moved to a school of international affairs where I taught international political economy with political scientists, and then I moved to business school, and now I'm in a law school. You know, so I feel like a jack of all trades and master of none here. But there is some advantage in reading across disciplines and recognizing that the problems we face, I've called some of the wicked problems. Some of the wicked problems we face are like elephants. You can't just get them through one route. You can't just study law and say law is going to give you the answer, or you can't just study economics or management or accounting. It helps to, if you can't do it yourself, because it's very time consuming, you can put teams together. You know, teams are a wonderful way to bring someone with an MBA together who has an LLM and someone else has a PhD in economics. And once you can learn the language and go across, it's very helpful. I've written actually, I guess 3 papers now with Neerja Srinivasan. Neerja was head of transfer pricing for Dell Technologies for a long time. And what I've learned very much is there's a very different language when you're working with someone who's a vice president of a multinational than someone who's an academic. And so you do have to learn the language, right, going across. But I highly recommend branching out of the main discipline that you are and go broad in some others. It's so easy these days. Everything's electronic. You know, you look up transfer pricing and is published in about 40 journals now. Management, accounting, you know, economics, law. And so the opportunities are there to really go a little bit broader than we normally would do.
Hans, is that something, I mean, you hold a senior position within the tax authorities, and there is a bit of a war on talent, so to say, in the tax world. It's very difficult to find people for us as well in the practice. When you hire new people, do you take, for instance, the view that Lorraine just has explained, a broader view into account?
Yep.
And how is that going?
Yes, of course, we do not like to have only people with a legal background, but we also looking for economists, because what we see in transfer pricing, when you have only a legal approach, you end with the contract and you really do not know how unrelated parties would act. And that's very complicated, because we think what multinationals do in transactions between related parties, and we go to the outside world and we look how unrelated parties will do that. But to be honest, very often those transactions never happened between unrelated parties. So you need people, yeah, maybe also, yeah, who can think about what would happen in such a case. So economic theory is very important for a good approach of transfer pricing cases. So we look for people with a broader scope and not only from my profession was an accountant, but we also have people who are economists. So we hope that we can attract them. And we also hope, that's another problem in the Netherlands, that also our course would be more diversified, because those are always people, they look to the law and look of it, it's within the law. And when it comes to more the economic theory, how would unrelated parties work? They are offline at that moment. So also that is that what in the past we tried to give them some seminars also about transfer pricing, how it works. But even in the OECD, I see that problem that the countries, but also the secretariat of the OECD, I think it's very difficult for them to think how would unrelated parties work, because and then they always go back to what's in the contract, and I try to price it and I have a benchmark. But yeah, it's the first thing is always for me from an economic theory, would unrelated parties would go into such a transaction, because the main reason of the problem of tax haven and intangibles is, I think, that we were pricing transactions which were nonsense, because nobody who has a very valuable intangible of a brand name would sell it to someone in a tax haven, because someone in a tax haven wouldn't buy such an intangibles because they cannot add any value. And I think the only transactions which happens in reality is where both parties have an advantage of doing that transaction. And if the only advantage is a tax advantage, then it's in the end, it's nonsense. But that's now that theory, we started because in the Netherlands, we have more an economic approach on transfer pricing. We started before the BEPS project to explain to our colleagues. They laughed at us because that's nonsense what you are saying. And we are happy with the BEPS project that it's more clear that those transactions are nonsense and will lead to a price adjustment clause or whatever. But I think now we are. I think at this moment it's going better, but there's a lot to do. Also I think the OECD should find economists who can explain how economic theory will work. That's also what we want to do. But in the Netherlands, we did it for a longer time. And that was also one of the reasons, to be honest, that there was a huge difference between the theory of countries like US and in the Netherlands. And that gave also the possibility that part of the profit was not taxed at all because of our informal capital jurisprudence, which gave the opportunity to have a downward adjustment in the Netherlands because we have another approach than in other countries. Now, that's not possible anymore since a year, but that in the past was part of the problem in the Netherlands for structures where we're not what we think now, we all think now that we're not completely ethical, but it was based on the
question on that, because Lorraine pointed already out, I mean, the Netherlands was a well-known place to exploit actually the hole that was made or created by the US with the Jack the Box regime. I mean, the CV, BV structures, they were exemplifying that. Well, we could look at the United States and ask the question, which in a way is also a trade question. I mean, it was a way of supporting US multinationals in sort of subsidizing them in making, foreign direct investments, and without, well, really having any disadvantage for the US Treasury, but, well, basically it it reduced foreign taxes instead of US taxes in a way. That was the US part. The Dutch part was also to say, okay, it's nice and we take our part of this. Has that ever been some sort of an ethical discussion within the authorities, whether we should do that, and how did that discussion go?
Of course, that was a discussion for years, I think. But the outcome of that discussion was, at that moment, we are not the inspector of the world.
Mm-hmm.
So if the US is not taxing the value of their intangibles, why should we do that? And so that was the discussion, and it was for companies, it had an advantage to come to the Netherlands because we had a downward adjustment on part of the income, because the Dutch tax inspector looking to the law, and he was completely right, only taxed the arm's length profit in the Netherlands, not looking what was happening in the whole world. And I think that was because of that discussion, and I think it started with the Starbucks case, which came in the open air, and there was a lot of public debate, and also political parties thought, oh, what's happening here? Consumers were saying, I do not want to drink a cup of coffee at Starbucks. So I think that changed the environment, and that also changed the discussion of ethics related to the question, is this fair? Not only fair, is it fair for the Netherlands? Because I think we tax what could be possible looking to the arm's length principle, but is it good to accept that part of the world profit is not taxed, or should we do something? And that's why with the new law, we also tax part of the profits where the other country will not tax that arm's length profit for their country, which we do something which is not our profit, but as long as the other country is silent on it, we will tax it. And if the other country say, hey, that's my profit, I want to tax it, we say, okay, you can have it. So that's the new idea, where I think in the Netherlands, in our law, we think we are all responsible that all the profit in the world should be taxed once. And in the past, I completely agree, the main issue in transfer pricing was that there should not be double taxation. And now I think that the balance is going more that we want to tax, we want that all the profits will be taxed once. And now the discussions will come with Pillar 2. Also, it should also have a minimum tax so that the arbitrage possibilities will be lower in the future. So you see a real change in the Netherlands.
And that is a change also in the ethical standards, in the sense that the ethics in content-wise changed, or because if I'm a little bit critical, I could also say, well, it is part of the rationalization. So I'm not the inspector of the world. I mean, so that is a rationalization maybe of saying, well, hang on, why wouldn't I? I mean, has our view really changed? So ethics change over time, I believe. I think there might be even a time when we find it strange that we eat meat, and that there was one. I mean, take smoking. 25 years ago, everywhere, everyone would smoke, and now even people who smoke stand outside their home to smoke, their own home. I mean, why wouldn't they? Yeah. So people change, their thoughts or their ideas change over time. So is this a change of ideas, or? And I'm interested, I mean, not to judge anyone, but more to have an interest to what extent that discussion was already. Did you had that discussion earlier, or was it a general feeling, well, we're not the tax inspector of the world, or were there people saying, wow, hang on, is this still?
I think you always had also within tax authorities part of the colleagues say, this is strange what we are doing, but others say, no, that's not strange what we are doing. And it is also good for our investment climate. So you have always that debate, but it only changed because there was a public discussion and there was involvement of what the people thought, and it became more clear. Because some people say, was it dependent if we had a government with left-wing parties or right-wing parties? Now I can say you that also when there was the Labour Party, Partij van de Arbeid in the Netherlands was in the government, it was not a serious problem. It became a problem when it was in the news, when it was a discussion in the public was there, that people thought, oh, we have to do something. And that was not only in the Netherlands, it was all over the world. The Starbucks discussion started in the UK. So people were, and that was after the crisis of in the century, the people had the impression, yeah, we need to tax and we need to be more severe to financial institutions. So something should change. And that was part of that broader change that people thought, well, we have to tax the multinational more fair, whatever it is. And I think that was the reason that it also gradually changed in the Netherlands. And
But there was an outside pressure, so to say.
there was an outside pressure with what was very important. And you also see that Secretary of State in the Netherlands also changed the opinion gradually. So we have to change. And maybe now we have shifted to another that we the best kid in the classroom sometimes, because in the Netherlands, I think we are relatively transparent of what we do. I do not know what happens in other European countries, which is not so transparent anymore. But because in the end, there's always tax competition between countries. You see it also, maybe we will discuss that the amount A and amount B proposal. In the end, it's also a struggle between countries to have a larger part of the pie. That will always happen. So, and even in the Netherlands, we also want to tax enough money that we can have schools and hospitals and whatever. So there's always a tension, but I think there was a real shift in thinking about, am I the world inspector or not? And I think we are more looking to what is the effect of what we are doing for the outside world, with a special interest for developing countries, because there are two issues in this debate. It's an issue of base erosion and profit shifting. That's in the interest of all countries, I think. And there is a discussion about source and resident countries and how you should allocate the profits to developing countries. And you see in BEPS 2 more attention for the source resident discussion than in the past. So I think that's the next step we make, and maybe that's even more difficult because there's not one in the developing countries. There are also different situations, so there's not one developing country, and you also have countries like India, China, Brazil with other interests. So it's a world game at this moment. But it's very interesting that in BEPS 2 you see a combination of the base erosion profit shifting goal, but also the goal to have a better division of taxing rights between source and residence countries, and with a special interest for low capacity jurisdiction and developing countries, which is also not exactly the same.
I think it's a nice moment maybe to shift gears towards the second part of this session, Rutger, which is about the future of transfer pricing. You start talking about BEPS 1 and 2 already, and we have discussed the arm's length principle, the problems of the arm's length principle. But is there an alternative out there? Is there a better way to go forward? There has been discussions about this topic also for a long time already. We heard from European Commission when we, around 2010 with the Common Consolidated for Corporate Tax Base, triple CTB. Then these days it's called BFIT, right? Pretty much the same, but labeled differently. We have BEPS 1, which is some sort of a formal reapportionment. Lorraine, you have
Pillar 1.
Oh, sorry, Pillar 1. Yeah, Pillar 1. Thank you. Pillar 1, indeed. Lorraine, you have written an article about the arm's length principle, basically coming to the conclusion that it is enabling, if you like, unethical behavior, but you are also a strong supporter of the arm's length principle.
That's true.
Yeah, so
Explain.
Can I use the same kind? Well, you see, I really have believed that the abuse of transfer pricing is the messenger that was telling us there was a problem. Going back to the regime literature, I really do believe there is an international tax regime centered around residence and source principles, with first crack right going to source countries, and with a whole set of double tax treaties, and with the OECD Secretariat really is the organization at the center. And in places I've called this the OECD tax regime.
Which is a fundamental concept.
Yes.
Yeah.
And then transfer pricing is in effect a standard or a norm within that is used. If you think about it, you actually have to determine if you're going to set up an international tax system, you must decide the jurisdiction question, the allocation question, and the valuation question. And the valuation is the transfer pricing part. How do you value cross-border transfers? Because that's important for determining how much profit is here and how much profit is there, right? So my own view is that transfer pricing in and of itself as a principle and a norm is fine. It's a thought experiment that makes sense to me in economics. It makes sense to me in business. Some of my earliest writings on here go back to talking about Jack Hirschleifer, who basically did the arm's length principle in 1957-58. Didn't call it that, but he said, when you have related party entities and there's no government, throw away the government, there's no government, related party entities, and you have something moving between them and you got to price them. How should you do it? You should do it based on the Hirschleifer principle. What would the price have been without their, So I think there's very good, strong economic arguments for using the arm's length principle when it's put together with residence and source principles from 1923, right? From that early report to the League of Nations, which I think still stands really well. It does. Having said that, I think that if we fix, as I said, some of the problems at the top, which I really do think I'm in agreement with Hans here. I think there's been a lot of movement to recognize that we've moved from focusing on avoiding double taxing to we have to avoid zero taxing, double no taxing. Nobody taxes it anywhere. The original article by, was it Kleinst? The Kleinst article on double no tax was written about Starbucks. Yeah. was really kind of a fundamental article in setting up the tax justice network. Played a very important role, I think, here. For me, there's a very interesting link to that in the CSR literature. If you think of the definition of corporate social responsibility, it's not compliance with the rules. It's going above and beyond the rules. You do not engage in CSR unless you go over and above the rules. You do better than the current standards. Well, think about that in terms of tax avoidance. Tax avoidance said you use the rules, you stay within the rules, you use the rules. If you want a CSR approach to tax planning, what you have to say to the CEO of the multinational, you can't just use the rules. You must go over and above compliance with the rules to show that you are socially responsible here. And I think we can do that. So I really, and I seems kind of funny, but I do not see throwing out the whole system and moving to global formulary apportionment, which is not principle based. I mean, it is not, there is no principle underlying it. It's based on using allocation keys that are based on labor and sometimes property, plant, and equipment, which are 19th century concepts. not 21st century concepts. Doesn't measure intangibles, doesn't measure digital transactions. So formulary apportionment might have worked in the 1800s when we were property, plant, and equipment and labor based, like the labor theory of value. But I don't see how you can use those allocation keys in the 21st century and have them mean something. I also think some of my early work on global formulary apportionment, you can play with those. You can play with those metrics. Every country has the right to play with those allocation keys. Firms can move their bases. The only experience we have with GFA primarily is in the US states. And if you read, again, reading history is very useful. You read the history about how GFA has worked at the state level. Every state picks its own rates and bases and moves them around. And there is a commission that coordinates them, but loosely, maybe is the best way to say it. In Canada, I'm a Canadian by birth. Canada also has formulary apportionment for the provincial tax. Quebec is out. Quebec never joined. But the rates are getting, it's a little more of a federal top-down system. So, I mean, I have said to the OECD Secretariat, tell me who's going to be the benevolent, omniscient dictator who is going to make this work, right? In order to prevent the tax games that formulary apportionment can do. I also, one last comment, and I'll just come back to BFIT. I think it would, if we are going to play with formulary apportionment, I hope the European Union goes first and adopts BFIT, and the rest of us can not have Pillar 1 amount A, and we can just watch what happens in the European Union.
Love about it.
And laugh about it, frankly.
Laboratory,
It's a lab,
experiment.
that the EU BFIT could be a lab for the rest of the world to watch for 10 years. And if the EU can work it out among itself, you know, now that
Without starting a
Britain
war.
is left, right? And remember what will happen with BFIT. It's going to be layered on top of the existing system with a group of countries that are not doing formulary apportionment that have to be, I think of them as tectonic plates kind of grinding against one another on here. So I don't know what Hans thinks about this, but I think I'm not in favor of formulary apportionment. It seems to me in many ways an old tax is a good tax, that the lawyers and economists in 1923, 100 years ago, were right, that they thought about the problem. It is possible to do it with intangibles. I think action items 8 to 10, value creation, are a big help in transfer pricing. You and I are on the same page, I think, on this. And
Yeah, I see you look a little bit. Now it's getting interesting.
The political right answer is that it's in our law, so the arm's length principle is the right way to go ahead. But to be honest, looking to what's happening at this moment, is that the BEPS action 8 to 10 are good and they are helpful, but not a solution for all. I see still a lot of things where I think that's not arm's length, and we cannot tackle it with the arm's length principle. That's very difficult.
I disagree.
So I see that as a problem, and I'm not a believer of formulary apportionment. So, but I think we should think in the international organization what will be the best way forward. I think what you see at this moment with amount A, and that's because I think governments thought BEPS was not enough because of the digital economy. The world is changing. Countries want to tax more because they see a lot of economic activity, but not value created. So we want to tax the profit more near the consumers. And we do that in amount A, not based on a principle, but based on a quantitative approach, which I think is that, does it make sense from an economic perspective? Very often not, but you see that they move in that direction. And what's happening now, that you have the arm's length principle for profit allocation, and above that, there will be an amount A, if it will be a success. And to be honest, I really do not know. We will see in a few months if it will be a success. But that is the directions where the governments are going to. And I think that's yeah, in the end, I think from a conceptual perspective, it's not good to have two systems above besides each other. It will give disputes about the arm's length principle, and it will give a lot of disputes about amount A. And I think we have to choose, because I think the arm's length principle is based more on value creation, and amount A more to where the products will be consumed and be taxed. And I think it's difficult that will be the future. So I see this as a step where I think there's an indication that countries and governments and maybe the public, I do not know, want to have more, not a principle-based solution, but also more a rule-based solution. And now it's a mix of both. So I think it would be a challenge for academia, just like you, to think about, is it formulary apportionment or arm's length principle, or is there a solution which is more fit for the future? I see the debate also about amount B in pillar 1, and that's based on the arm's length principle. Yeah, I think it's a good project, but you see that it's still based on comparability studies to transactions, which are not the same as the transactions we are looking at for the tested parties within the M&E. So yeah, sometimes I have the feeling that we are near what is possible with the arm's length principle. So there is a challenge for us all to think about what is a good alternative, because besides what is from a conceptual view the right answer, I see that governments are going to a situation where they want something for developing countries, which is very good. And I think, to be honest, the arm's length principle is much too complex for developing countries at this moment, when you look to their possibilities to make adjustments or to do audits. So it should be simpler in the end. And the arm's length principle is not simple. I cannot explain the arm's length principle to my neighbor, and that's a problem. We have to, and if you have something which is more rule-based, maybe it's not ideal from what we are used to from believers in the arm's length principle, but maybe we can better explain what we are doing. It's getting too complex, and especially when you look to all the discussions about the arm's length principle, and I was in the OECD for, I think, 13 years, it's getting more and more complex. The blue book, when I started, it was, I think, 200 pages. Now we have
79
it's yeah,
and 20, I guess.
And if you read the paragraphs, I do not know if you before you go to sleep and you start reading the book, it's a nightmare, because you do not understand what's in it, because these are compromises on on the interpretation of a principle. That's what happens.
Yeah.
And even and I was there in the discussions, and we have debates about. And I'm not a native speaker, so for me it's very difficult to answer. It may be, or it should be, or it can be. Now debates of an hour about the wording, the drafting, the wordsmithing so, and that's like, is that what we want with the principle? In the end, there is a challenge to look if there is an alternative, and I think that governments are not able to do that at this moment. That's what I have the feeling also in the pillar 1 discussion, that for government it's very difficult, also because of the they want all to have the largest part of the cake in the end. So there are a lot of interest, and bargaining power of countries is very important. So I think it's very good that more a neutral I think university can play an important role. Think about the future of it, taking into account that for governance at this moment, it's very difficult to use the arm's length principle. for a fair taxation, going back to what we want with this world. Because the outcome of the arm's length principle and the sharing of profit between countries is not, yeah, when I walk in the OECD buildings, they have their logo and better policy for better lives. And I'm always thinking, what am I doing today when I'm here in the meeting? Is that really brings a better world? Now, I doubt if that's really happening. So, and it's nearly impossible with all the interest at the table and countries like China, India, US, Europe, with all their own interest. And they are willing to do something for developing countries. But to be honest, not too much.
Maybe you can also a little bit enlighten us on your work for the UN subcommittee, because I think that touches quite.
As Hans said, and I think that would be right. That's my sort of assessment of the OECD too, is that willing to do something for developing countries, but not too much. That's, I think, why the pressure has come now from the UN, led by ATAF and Nigeria, to think about making the UN a home for doing tax. As I talked about, the international tax regime that I think is in place today really has been an OECD regime led by the OECD Secretariat in Paris. And the Working Party 6, for example, that Hans has been very much with Western perspective. And the BEPS project, particularly the BEPS 2 project with the inclusive framework, is now brought on many more countries that are sort of at the table, but really don't have the same level as a full OECD member country. And the OECD membership is also growing too, but it's still very much a rich countries club. And I think the impression has been that double tax treaties have been primarily about capital exporting countries and getting withholding taxes down and avoiding double taxation, which benefits residents countries. And the perception is that the UN, which has much larger representation of developing countries, and the UN Tax Committee with its own UN transfer pricing manual, has been much more focused on from a source-based perspective on, if you think about it, most OECD member manufacturing multinationals, a lot of their manufacturing is actually done in the developing countries. So the property, plant, and equipment and the labor are in developing countries. That's source-based countries. And they want the right to tax it, right? So the problem has been if the entities that are there are declared to be routine, they can only make a routine return. And
that's why we have the arm's length principle.
I
so
know.
they can use it. So,
but again, this I would come back. This is a bit of a chicken and an egg issue. What's routine? Some multinational, on the advice of a big four firm, defined it as routine. And because it was routine, it therefore could only earn a routine return. Meant it never earned a loss, but it could only have a routine return. I was involved in one case, I will not name the case, where there was paper going from the head office that the head office said to this subsidiary, you have been an entrepreneurial entity so far. We have decided you are going to be routine. And so we want you to sign this contract to say that you are now switching and going to be routine. And that would then, by the definition, the change in the definition as to whether the entity was entrepreneurial or routine could affect the amount of rewards that were there.
yeah, but now you're saying that the arm's length principle.
No, I'm saying the principle is fine. What I'm saying is that it can be, the principle itself can be abused. In other words, there's a difference between how should I say it, the letter of the law and the spirit of the law. I think a lot of the compliance has been with the letter of the law and not with the spirit of the law. The spirit of the arm's length principle, blah, blah. If the entities had been uncontrolled, what would they have done under the set of same sets facts circumstances is a thought experiment that we can engage in and come to a rough answer, I think.
Yeah, but I think countries will use the arm's length principle very often say that their company in their country is the entrepreneur as long as there are profits. And at the moment when there are losses, they are routine. And I think that, yeah, that's within the range of possibility within the arm's length principles, because you always have companies who are not looking for risk and saying, "No, I'm happy with the cost plus remuneration, even if I do a lot of very complex things." And it also goes the other ways around. So you have a range of possibilities. So it's normal that companies and also tax authorities make use of it. And that's why I am critical on the arm's length principle. And if you are going the road, say now, when there is a very a plant in a country with a lot of complex functions, yeah, in the end, you come always to a profit split discussions. And my experience with profit split discussions, especially in multilateral APAs and bilateral APA, that in the end, I have the idea we are near formulary apportionment what we are doing, but because we do not know how to split the profit, it's too complex because we are not business people. And what we are doing, we look at how many people work here, how many assets, how many. Now, and I have the impression that at the moment when you do that, if you are not willing to use the very easy way of transfer pricing, one is routine and the other is entrepreneur, which is nonsense. I completely agree. But if you want to deviate from that, you're coming in discussion about profit split. And then it will be even worse, I think. And I think then it will depend on the bargaining power of governments, what the outcome of a profit allocation will be. And then I think now let's look upfront what will be the allocation key, and not every case again and again. Well, that's happening because the dispute at this moment. I'm also doing work for the MEP team in the Netherlands. Every year we have 10 to 20% more dispute cases. So within 10 years, I think we cannot work with it anymore because the disputes are growing, especially also because countries thought, hey, transfer pricing, arm's length principle is also a possibility to have more taxable income. So I think the discussion, which was 20 years ago, was more about avoidance and tax schemes. It's now going a fight between countries about who can tax the income. And there's a risk because there was an advantage for companies to have a wide range of possible solutions. Now maybe they are now more responsible. But now you see a fight between countries.
Without totally mentioning with whom I agree, just
no need. You're
just on the profit split, and I've dealt with quite a few as well. And indeed, there comes a point where you come to a conclusion and say, well, the contribution by this party is this, by this party that, but it's more based on interviews and views of people. And then when you really need to determine it, tax authorities start asking you, can you quantify it? And then when you quantify it, they say, well, the best metric for quantification is salaries of people, payroll. There's no better indication. What would you say about that?
Well, my own view and the work that I've done on this is that, focusing on trying to look at the whole global value chain for the firm. So mapping out the GVC for the multinational in the particular product line, all the entities that are involved, with what the entities are actually doing. And I think this is what are the roles and the responsibilities of each of the entities in the group can help you identify which ones are entrepreneurial, the ones that are actually taking on strategic risk, upside risk and downside risk, right? Not just upside risk. And then which ones are not taking on strategic risks. And I think a focus on, it's been the 482 regulations for years now, on conduct, capacity, and control. Who is exercising managerial control, right? Who's actually making the decisions? Who has the capacity? Who is taking on the risk And how is that risk being borne and insured? So the concepts of conduct, capacity, and control of roles and responsibilities of entities in the group within in the product line, and mapping those out is a way to help think about where the value is being created. I think if this is the maybe almost the diagrammatic way to think of action items 8 to 10. Is you want to look at value creation. You need to do this in the concept of supply chains and value chains, what the entities are doing within the group, not on what the multinational says they are, they're routine or non-routine, but what they actually are doing. And that may involve, it can be fairly sophisticated in terms of speaking with managers and asking, who do you report to, right? Who's under you and who reports to you? What kinds of degrees do people have? Now, I agree this is expensive and time consuming, and it probably only happens in the largest of cases, but country by country reporting could do a lot. If that were more, better information were asked on the C by CR reports. I also think public of beneficial ownership. And there's a lot of work going on now in international business about entities that are simply on paper entities, that are just simply used as conduits to move money around in the multinational group, but actually there's no people there. Come back to Hans's earlier mention of permanent establishments, right? And the problem with figuring out what value creation is in a PE and the PE rules, for example, the AOA approach that the OECD has proposed, but not many countries have adopted. Comes back to talking about who's doing the conduct, capacity, and control here. Maybe just a quick sort of summary of thinking about this. I think we've spent what now? 2015, the BEPS 2 project with the three, it was originally 3 proposals that became Pillar 1 and Pillar 2. An enormous amount of time and energy and money and people power has gone into Pillar 1 A and B, Pillar 2 Globe, and the other component, the STTR part of this. I think to myself, what if we had spent that time really thinking about transfer pricing in the digital economy and how we transfer price digital transactions? I think the original methods, think about the original 5 methods, not this Brazilian 6, but the original 5 transfer pricing methods. Those were primarily set up a long time ago in terms of thinking about a single buyer and a single seller. The CUP method is based on the single buyer and a single seller. So is the resale price method, the cost plus method, all of those are single buyer, single sellers, with the exception of the profit split method, right? That's not how multinationals work today. Most of that trade is not single buyer, single seller. It's a group of entities in a strategic
Networks,
alliance that are in networks, and figuring out how, if there's 5 entities involved and the transactions moving in interdependence, say, for example, 24-hour global tradings, sequential interdependence or reciprocal interdependence, that's the problem we have to deal with today. And the digital transactions today, but what we've been doing the last 3 or 4 years hasn't addressed the 21st century in my books. It hasn't really addressed digital transactions. It hasn't got past action items 8 to 10, which I think were helpful, but are not enough to get ahead. That's why I think things like Shapley value, I think better and more sophisticated allocation keys in the profit split method would help. The allocation key is based on capitalized, amortized R&D spend primarily.
Wouldn't that come basically what Hans said,
Yes.
become a formula apportionment in the end?
Well, let me say the profit split method does have some formulary apportionment to it. So does thin cap rules. The 3-to-1 thin cap rule has that. The United States has a rule for if you're borrowing around a multinational group, has an in situ rule that says if an American has a subsidiary here and that subsidiary is borrowing, it has a subsidiary in Canada, is borrowing from a Canadian bank. And you could figure how do you figure out the transfer price? You do it as in situ when you figure out how the American parent would have done it plus a markup. I guess what I'm saying is I think there are a variety of safe harbors in the existing rules. And there are some like thin cap rules that are 3-to-1, which are done for administrative convenience and simplicity. And I think I was listening to the frustration in Hans's voice, talking about how difficult it is for governments these days and the number of disputes. And I think I get it. You know, I understand the frustration. I think the frustration is there, not only on the part of governments and national tax authorities, but on the part of the multinationals too. And the tendency is to go for what one thinks of as administrative convenience and flexibility. And formula sounds simple. And it would be if we had a benevolent, omniscient dictator, I guess, to manage the whole thing at the top.
I'm available.
You're available, yes. So I think I think we still have a problem. I totally believe that I think the arm's length standard can work, and it's the best we have. Substituting formulary apportionment will only layer one on top of another and create even more rules.
I agree, but all what you said the last 5 minutes is about the development of business nowadays in multinationals.
Yes.
About digital economy,
Yes.
about the networks, about people flying all over the world within a multinational.
Mhm.
There are no such transactions with unrelated parties. And that's the problem. We think we can compare them with what unrelated parties would do, but they do not act in that way anymore because the world has completely changed. In the past, you had a plant and you had a head office and you can compare a plant with an unrelated, but that's not happening anymore. And that's why it's so complicated for the digital economy to do something with the arm's length principle, because can we compare it with what unrelated parties would do? I do not know situations.
Simply have one concept in place that we say altogether, profit of a multinational should be taxed somewhere, and then just.
I actually think it matters by whom, though. I think economic allegiance matters. And the question is pinning down that economic allegiance when it's digital transactions, right?
But that discussion will come up anyway, once you
Yes.
have the basic principle there.
Mhm.
I mean, I've always, if I try to explain what I do in daily life to my children, and one of the
Poor
things,
children.
yeah, poor children. And I once compared to work with one of my son's friends who is the son of a divorced couple. And I said, well, what does this guy do? He goes to his dad in the weekend because dad is relaxed on going out. He goes to his mom in the weekdays because he has better food there. He arbitrages.
Mhm.
And if dad and mom they quarrel, and they do quarrel because they are divorced. If they quarrel about the rules being set, it is the son
Yes.
who will exploit.
Mhm.
So as long as dad and mom are not capable of coming together and saying, this is what we want for the education of our son, then he will exploit. And to that extent, that is what I do, because they ask ethical questions to me as well.
Should become a divorce lawyer.
And they do ask ethical questions as well to me. And so, okay, Dad, but so this is the Apple type of work, that is the work that you did. And as I said, it is ethical behavior is about what you do when people don't watch, right? So at the end of the day, isn't it partly also just that states are not capable to be mature and have mature.
Yeah.
Well, that's why we have the UN.
Yeah.
Right, is so that you put the countries together and you have an open forum and an opportunity for all countries to have a voice. You do still have national sovereignty, and facts and circumstances do differ enormously across countries. but you have a forum where every country has the opportunity to speak. You know, you set up committees and the committees try to work together. I really believe the solution here is international cooperation among nation states.
Basically what I'm saying.
I do. And
Hans.
I mean,
You look a little bit more cynical.
you may be, yeah, well, and I agree, there, countries are different sizes and, you know, different power and, but still in this, what we're dealing with is a wicked problem. It is going to be with us. You're never going to solve this problem of straightening out the taxing of multinationals and cross-border income. You need to manage it, and it's better to manage it through cooperation, I think, than competition.
One last word.
Yeah, I think the idea that the OECD is only an organization for rich countries is an idea of the past, I think, to be honest, because I see a lot of people from non-OECD countries at the table with a good and loud voice. So I'm not so pessimistic on that. And the idea is doing that discussion within the United Nations. Will it change a lot? Maybe some more countries are at the table, but they are also welcome in Paris. So that will not dramatically change, I think. And to be honest, I think when the same countries are at the table to discuss the guidelines, if it's the UN guidelines or the OECD guidelines, and we want to have a consensus view on transfer pricing, and that's necessary to have a fair way of dividing the cake. Yeah, I think still that countries like US, India, Germany, France, Canada have more impact in the discussion than the developing countries. So that will not change. So I can imagine that countries, also developed countries, think it's better to do it there. But yeah, and you also need the resources in the United Nations to do all the work. So a lot of people who work in Paris should move to another place, because we do not have at this moment in the UN the capacity to do all that work. So I can understand the discussion, but I doubt if it will be the solution for the problem we are facing, and where we agree upon that the taxing rights of developing countries is still a huge problem because of capacity building, because of, I think, the bargaining power of some countries. It's really, when I say something in WP6, they listen to me, but if the US say something in WP6, they listen a little bit better. Because they have more influence in the discussion, and we are both developed countries, but the bargaining power of countries like US and also China at the moment, India, and India is even not an OECD country, but their influence is growing. And looking to the people living there is the most inhabitants of the whole world, and you see that change. So I'm more, and I have the impression that, and also because the Secretariat of the OECD wants to do the job, they invite more and more the voice of those countries. So I think it's not the solution for what we are facing. I think more the solution is that we will tax on a minimum tax rate, and I think 15, my personal opinion, is not enough, and that we are transparent to each other, that we have good criteria how to split the profit, and in the end, if the tax rate is everywhere the same, and there are less loopholes than nowadays, in the end, that may be a way to a solution where the income will be divided based on what's fair. We should have a discussion what's fair, because that's dependent on what your ideology is in the end.
We're slowly coming towards that. I don't know if we have.
I guess so.
Yeah. Would you like to say anything, closing remarks, or can we?
maybe a closing remark is it's very good to have this kind of discussion about ethical behavior in taxation because it's not only the technicalities which is important and the debate should continue. And I think the most interesting thing here in discussion, what is fair, because that question we didn't answer until now, but maybe that's a follow-up.
We already have a subject for a next.
I'd just like to say thank you for inviting me, and I really enjoyed this opportunity. We don't have many opportunities to sit down with experts in the field and talk about where we've been, where we are, and about where we need to think about going. I think the problems are with us. 2030 is right around the corner with the Sustainable Development Goals. They are not going to have been, they're never going to be achieved, but they're not even going to be managed, I think, by 2030, the wicked problems. And tax is part of the solution. I think figuring out how that I agree that taxes, the profits of multinationals are taxed at least somewhere once. Is an important issue going forward. And I also agree fairness is in the eye of the beholder. It's a normative issue and people disagree on normative issues, right? And so this is always going to be a problem. You know, what I see as fair for me, you don't necessarily see as fair for you. I remember, maybe I'll close with a comment from someone who I disagree with vehemently in terms of formula apportionment, which is Saul Picciotto, who was very much for it. But if you remember Saul's book on international tax, he talks about transfer pricing and saying there's two approaches to transfer pricing. One is to focus on the pricing of the transaction, and the second one is to focus on income allocation. And he said, the problem with income allocation is it's about fairness, and fairness is in the eye of the beholder, and countries will fight.
Yeah.
So if we do transfer pricing based on income allocation, there will be all kinds of tax games. There will be all kinds of fighting. So we should do it on the basis of pricing, and which what we did. But even still, it came down from formula apportionment, which is an income allocation approach. So I think, yes, there are strong links between ethics, corporate social responsibility, and tax. And we don't talk about them enough, and I'm glad to have had the opportunity to do a little so today. So
Thank you very much. It's been very insightful.
Yeah,
as
absolutely.
well.
And one thing that I learned and feel supported is that we have to have a course on the history of
And
tax
history.
and thus also on transfer pricing.
Thank you all.
Thank you so
for joining
much.
us. Yeah.
Give a big hand
Thank
to
Great evening and on to Egdom.
It was fun. Thank
Thank
you.
you.
Yes, very
I guess I think you see the glass as half empty, and I think I see it as half full.
good.